Welcome back to CapexForexTrading.com. In this video, we're going to focus on the bid, the ask, and the spread. But firstly, what I want to do is just focus a little bit on the pricing structure for currency pairs. Now, on the right-hand side here is a price for this currency pair. Now, some brokers tend to use 5 decimal places, some tend to use 4. The actual price itself is the same. It's just that some brokers decide to take the last digit out. Now, what I want to pretend for this example is that the price, which is highlighted in the black box here, is at a standstill. So let's pretend that that price currently is 1.35507. So what does this mean? Well, the chart showing in front of you is a chart for the Euro USD. So the first currency listed, i.e. the Euro, is the base currency, and the second currency listed, i.e. the USD, is its counterpart. So this price here means that to buy 1 euro, it will cost 1.35507 US dollars, or 1.36 if you want to shorten it. So in terms of the actual buying and selling prices, which is generally how most people refer to those prices as, it is really worth knowing what the technical terms for those prices are. So the selling price is referred to as the bid, and the buying price is referred to as the ask. Now, you may read many technical articles about why one is called a bid, why one is called the ask, but realistically, this is all you need to know. Now, the spread is the difference between those two prices, okay? So these prices obviously are constantly moving, but let's pretend the difference between those two prices is 2, okay? That means that the spread is 2 pips wide, okay? Now, the reason for the spread is basically for brokers to make money out of you, okay? So the way that they do that is as follows. No matter which direction you trade in, whether it's up or whether it's down, you will always start, in this particular example, if the spread is 2, you will always start 2 pips in debt. So if you're trading $1 per pip, you will always start 2 pips in debt. Okay, so you will have to accumulate, no matter which direction you're going into, 2 pips in order to break even. Okay, so I mean, brokers do make money out of you other ways, but we're going to discuss that in a later videos. But in terms of the bid, the ask, and the spread, which is the difference between those two prices, that is all you need to know. But if you do have any questions or any comments, do let us know in the comments box below. Otherwise, we shall see you in the next lesson. Hi, and welcome to CapexForexTrading.com. In this video, we're going to discuss the main difference between technical trading and fundamental trading. So technical trading is purely based on chart analysis. The reason for this is because charts are viewed as graphical representation of human behavior. So by simply looking at one of your charts, you are able to see how the world reacts at various times of the day. Now, in terms of strategies employed in this trading style, you only need to concern yourself with chart patterns, otherwise known as setups. Now, we're going to record many videos about chart patterns or setups, and we're also going to teach you how to identify them, trade them, and when to exit. But in terms of example, what we've got here is a simple technical trade. So in this area here, we have a consolidation, which is defined by the top trend line and the bottom trend line. They make a sort of a wedge or a triangle pattern, but the trade that we're looking for is a break of this bottom trend line here in the downwards direction, and that's exactly what's happened there. Now, please don't trade this if you spot this at this stage, because there is a lot more that we need to teach you in terms of trading this pattern. This is purely for example purposes. Now, fundamental trading is slightly different. It is purely based on news or data. It is not concerned with any chart patterns or anything like that. In fact, a lot of fundamental traders don't even look at charts. They simply wait for news or data to be released on a daily, weekly, or monthly basis. Now, in terms of the type of data that we're looking for example, on the monthly basis, we're looking for the non-farm payroll numbers from the United States, which is the biggest monthly number. Now, even if you're a technical trader, you should stay away at the time that this data comes out, because it has the power to shoot drastically up or down. Now, on a more weekly basis, we're looking for data such as the US unemployment numbers, which is released from the US on a weekly basis. So these numbers obviously can make the charts go up or down. So if you are a technical trader and you are in a very small time frame, you should also stay away from trading these numbers. But if you're trading in time frames 4 hours or above, then you should be fine to stay in that trade. So in terms of example, what we've got here is a 1 minute chart. Now, the reason why I've circled this is because this is quite a high drop down. That's quite a big black candle in the market. And in a 1 minute chart, that's quite rarely seen. So this means that some news has been released at this point. It stopped the current uptrend going up and it's reversed back down very, very sharply. Okay, so this is an example of a fundamental trade when news has came out of either the US or some other country. So for now, that's all you need to know in terms of our examples, and we shall see you for the next video. Thanks.